Well, we've certainly seen a lot of volatility in the markets in response to how people are believing the coronavirus will impact upon the economies. And as part of that, we've had to review our forecast for the Australian economy. We now believe that the Australian economy will contract by 0.3% in the March quarter and by another 0.3% in the June quarter. That constitutes what we call a technical recession, 2 negative quarters in a row. However, we do believe that in the second half of the year, the economy will bounce back, and whereas it'll contract by 0.6 in the first half, it'll grow by 2.2% in the second half. So what's behind this thinking? Well, in the first quarter, the major impact is the impact that the virus has had on China. So China, which is our major export partner, has really impacted upon students, tourists, and our sales of commodities. But in the second quarter, the virus is common to both themes, but the theme in the second quarter is the impact the virus is going to have on the Australian economy and the world economy. So the impact on the world economy, and we've seen this huge volatility in markets and share markets falling by around 20% in the space of only a couple of weeks. That's going to impact upon confidence, both business and consumer confidence. And the impact on the Australian economy will very much be around what people spend. So we think that consumer spending in this second quarter is going to be down by 1.2%. Now, a lot of this thinking is structured around the idea that both in Australia and the rest of the world, we start to get on top of the virus by the end of the June quarter. And once I think that is happening and the number of new cases starts to slow, then we'll see a significant increase in confidence and a turnaround in activity, which will also spill over into the financial markets. That gives me comfort that the second half of the year will be quite a strong half. The implication for the unemployment rate is important. So when Australia has had a recession in the past, the unemployment rate has lifted from 6% to 11%. That was in the early 1990s and the early 1980s. This recession will be very different. It will be much more short-lived, and it's more like a major disruption than the recessions that we were used to in those periods. As a result, we don't expect the unemployment rate that's currently at 5.3% will lift much above 6%. Of course, these numbers are based on what we know today, and the government is preparing a fiscal stimulus package. That package should be very much targeted on protecting jobs, protecting incomes of employees and companies that have been most adversely affected by the crisis, and hopefully providing some income boost to, say, pensioners and potentially even the unemployed. The size of that package will be substantial. It could be as much as $10 billion, which is 0.5% of GDP. So if all of that 0.5% got into the economy in the second quarter, then it would offset the contraction of 0.3 and we'd actually avoid that recession. However, I think that's going to be extraordinarily difficult to achieve, because if people's incomes are boosted, it doesn't necessarily mean that they'll boost their spending.